Okay. All right. Hey, welcome everybody to the Thursday evening webinar here. We have a awesome special guest, Michael Plaks, and he's going to be going over tonight the different ways in regards to facilitate the IRS and the tax and the information that you need to make sure that you are in line with all of the requirements and the abilities to make your business as efficient as possible, especially on the accounting side of it. So really, without further ado, to make the most value of all of our time, I'm going to turn the event over to Mr. Michael Plaks. Thank you, Michael. How are you doing tonight?
Doing good. Thank you, Adam, for inviting me, and it's always a pleasure to work with the Prosperity Group, my friends, team, and AC, and all the great crowd that you have, and all of your members and successful investors. Tonight, we are going to talk about a subject which is not fun, but is necessary since it's beginning of the year and tax season. And if you look at the screen, you see my logo, and my logo is I always wear those sparring gloves to beat up the IRS, and that's what our topic tonight is. We're not necessarily going to beat him up every time, but we need to make sure that we do not give them too much in taxes, which is a difficult topic when we talk about real estate. So briefly, that slide introduces me for those who haven't met me yet, and I'm a black belt in real estate taxation, working in this business for 20 years and work exclusively with real estate investors. And our firm is rated one of the 3 top tax services in Houston. And tonight we're talking about taxation of real estate. The topic may be very complicated. We have short time, so what I want to do is go through several most important pointers with a focus on an investor who is new to real estate, new to this business, and new to tax consequences of being a real estate investor. So trying to explain the rules can take forever, and what I prefer to do when we talk about those things is look at examples. To me, examples always beat talk. And what we are looking right now is how a tax return would look for an investor who is a wholesaler. What the starting point is, we need to know where things go on a tax return and what we can and cannot put on it. So right here we are looking at wholesaler who made $19,000 in wholesale fee during the last year. So we're looking right here at on your screen. It would be on the right-hand top corner where we see 90,000. So first, the good news is that when you go to the IRS to pay your taxes, it's not 90,000 that you are going to pay taxes on. It's 90,000 minus business expenses. And in my example, business expenses were 20, reducing the taxable amount to 70. So 90 was a combination of all wholesale fees that we made in 2015. Then we deduct all kinds of expenses and reduce it down to 70. So 70 is what we are taxed on. The next couple minutes I want to spend looking at types of expenses that we can deduct on this tax return. And by the way, our webinars, I believe, allows us to answer questions from people who attend, and I appreciate everybody who is spending time tonight with us. There is a, Adam, is a chat option that needs to be used for that, right?
I'm sorry, say that again. Is it what?
Adam, where would someone type a question if they have a question for me?
Oh, yeah, right over on the right side, you have a chat section right over here.
Yes, right. That's what I think.
There you go.
Okay. So please use the chat thing. I'm looking at that periodically to make sure that any incoming questions we can address. But for now, we are looking at this part of the tax return, various expenses that we can deduct. Before I go much further, I want to clarify that tax return we are looking at right now is just an example. It's not a real return. If it was a real return, the guy who created that return should be fired. So yes, I created that return, but I created it for the presentation. Reason I say it's so bad is because there are way too many zeros. If the IRS looks at this return right now, the return screams the fact that we do not have any records, any bookkeeping, just guessing the numbers. Bottom line is it's going to be an IRS audit if we do it as sloppily as you can see right now on the screen. So we only use it for presentation, not as an example of how it really should look. So let's go to some of those lines, quickly see type of expenses we can deduct. So IRS gives us about 20 different lines where we can put stuff, starting with advertising, current truck expenses, and all of the other things here. Some of them should be pretty obvious. If you look at that and there is advertising of 2,000, it kind of makes sense what would go there, right? We would have here your mailouts, your newspaper ads, bandit signs, whatever you used for your advertising, you add that up and the total annual cost goes there. To the right side of that are office expenses, again, whatever they are. We have things like supplies, legal professional services, all of them sort of self-explanatory, except for a couple things that I want to stop on and talk a little bit about. One of them will be line 9 on that form, which has current truck expenses. That is $5,000, so how do we come up with that 5,000? In fact, we do not. It's software that will calculate that number, and that number comes based on mileage. So the easiest way to take a deduction for business use of your automobile would be to record miles, and should you ever be questioned by the IRS, their favorite question is show me the mileage log. It used to be very difficult, but right now it's not. Everybody carries smartphone with them, and all smartphones can dozens of apps easily available for tracking mileage. It's very simple. Every time you look up directions, and you look them up anyway, just click an extra button for the app to start recording, and you will have a mileage log. So at the end of the year, you count those miles, and each mile gives you roughly 50 cents. The exact number changes every year, but think about 50 cents. So if we had 10,000 miles of business driving and we enter that into tax software, that's how we will get this 5,000, which we see right now on line 9. So that 5,000 roughly represents 10,000 of miles driven by this investor for tax purposes. The next thing that could be unusual on this form is line 13 that talks about depreciation and section 179. We are not going to dive into technicalities and a lot of terminology, but what we will see on this line is any kind of equipment or any item of substantial value that has useful life of more than 1 year. So typical example would be your cell phone, your computers, your large tools, or any other type of equipment or big ticket items. They will end up recorded on that line, and the rules became much friendlier to investors and business people as of this past November. So for the last few weeks, we enjoy a much easier way to do that, but it still will end up on this line. I will talk a little later about those new rules and what they mean for investors. Another thing is, if we look at those lines, there are certain items that we cannot find a good place for. For example, education. Where do we put training? If you look at those 20 lines that the IRS offers, none of them is suitable to put in training and education costs. Fortunately, there is a line that says, line 27, other expenses. What we do with this line is on a different page on the tax return, we would have a room to list all expenses, and right now I brought it on my screen. where we have 5,000 of classes and seminars, 1,000 of membership dues, or any other type of expenses that you do not find a line on your tax return can be listed, then they are totaled, which is 6,000 in our case, and that 6,000 will migrate to the form which has room for various specified expenses, designated lines, and then other expenses where everything else goes up. So in our example, again, we totaled everything up. That's 20,000, and instead of paying taxes on 90,000 of wholesale fees, we are going to pay taxes to Uncle Sam on the 70. The next question I want to address here, the question that we get very often in my office is, so give me a complete list of everything that we can deduct. What deductions are available to real estate investor? Yes, we're obviously looking at some right now, but I need to know about everything that I can deduct. Here is my response to that question. You can buy online list of 300 deductions for real estate investors, over 3,000 deductions for real estate investors. The use of those lists is very limited in my opinion. I prefer for my clients to look at your expenses from the opposite side. Not try to find what you can deduct. More like try to find what you can not deduct. This is how I would suggest you approach this. Take records of everything that you spent last year. And we will go by bank statements, credit card statements, and such. Look through everything that was and ask yourself a very simple question. If I was not in real estate, if I was not an investor, would I have paid for that? And if the answer is no, I would not, it means that the only reason you did incur that expense and paid that money was because you are a real estate investor. And there should be some room, some place where those things can be recorded and deducted on your tax return. So when we look at a schedule, we either find a line which seems to be close to what we need to deduct, or we can always put things under that other expenses list, which gives us freedom to add things that are not specifically listed on the IRS form. So once again, my recommendation for finding all deductions is go from the opposite side. Look at what you already spent and go line by line and ask yourself a question. Was it related to my real estate business? And if it was, chances are you can deduct it. There are very few things that you cannot. And if you are not sure, always feel free to check with somebody who is specializing in that area. Call our office. We'll be happy to help you with this. So that was the part where we talked about wholesaling and taxes for the wholesaler. Before we move forward, there is one thing I want to show, and I'm warning you that's not going to be a good news for some of you guys, but we have to be realistic. If it's 90,000 in wholesale fees, and we have 20,000 of expenses, and that gives us 70,000 amount which is subject to taxes. My question is, or your question should be rather, so how much does it cost me in taxes? We are not going to go into a whole lot of detail of why and how, but I want to show you a tax return where that 70,000 is placed on the tax return, processed through the software, and what it does to your bottom line. I'm showing how that return would look like, and here is a number based on that 70,000 income. Your line 44, if you look right now on your screen, has a number which is 9,000 and some change. So we roughly have $9,000 tax that we owe the IRS on the 70,000 income from our wholesaling business. Unfortunately, that's only half of the story. And even when we talk math, it's about half of the story. Because if you look a little bit down on line 56, there is something else that a lot of new investors do not know about. It's called the self-employment tax. This is a second tax. So yes, you are sort of taxed twice on the same income. One tax is called income tax, and that's 9361 in this example. Plus, in addition to that, you would have a self-employment tax, which is a fancy name for Social Security and Medicare taxes. So they together create another 8598. So 9,000 of income tax and almost 9,000 of self-employment. You combine them, and the total bill is about 18 grand. So yes, unfortunately, that 70,000 wholesaling income after expenses will create 18,000 tax bill. So if you do math, like divide one by the other, you will see that we are talking of roughly a quarter, like 25%, about your tax burden of having been in a successful wholesaling business, give or take, in this case, created 25% tax liability. That's a very high tax, but that is the price of success in being in wholesaling business. Unfortunately, it can go higher. The number is not fixed. It depends on the overall financial situations, how big your family is, how much income you made in real estate, how much income you made from something else like a job. So all of that combined, when you calculate it, will create different numbers for different people. But we can look at anywhere from as low as 20% and could be as high as 40% in the worst case scenario. So when you are planning to pay Uncle Sam, and if you have not made any payments to the IRS for the past year, I'm warning you that the time is coming on April 15th, where you would have to pay up or incur very significant interest and penalties. And that amount could be, 20, 25%, 30, 35%, somewhere there. I always recommend my clients to look at set aside 1/4 to 1/3 of your net profit from this wholesaling business in order to have enough money to pay taxes. So as much as it hurts, there is not a whole lot that we could do in this case except tracking every expense very carefully and deducting that. Because in my example, we had 90,000, I want to remind you, we had 90,000 of wholesaling income, and at 90,000, I'm bringing it back on the screen right now, from that 90,000, we deducted 20,000 of expenses. Let's just assume for a second that we forgot about 1,000 expense that we paid in cash, did not record, didn't have very good paper trail or none at all, and forgot it at the time we are doing taxes. How much does it cost us? Remember my numbers that I was throwing around, say 20, 25%, about 25% was in our case. So that $1,000 of forgotten expense can cost you $250 in taxes. So how can you reduce your taxes? Your strategy number one is have great records. That really is as simple as that. Most of my clients, their biggest hole where money is going into, that biggest reserve where they could save on taxes, is not in some fancy strategies, but simply in carefully recording to make money in real estate, because it does cost money to spend money, and everything has to be recorded. Bookkeeping is not much fun to do, can get very complicated. Yes, obviously, I realize that. What we could do is we could help. Right now, I'm bringing on my screen my website, which is michaelplaks.com. It's my name. So MICHAELPLAKS, michaelplaks.com. First thing you see when you go on that website, there are 6 buttons, and one of them talks about buying our recorded seminars. I taught a two-day boot camp a couple years ago on correct bookkeeping techniques for real estate that is available through our website, as well as various other tools that I encourage everyone to explore when you go on our website. And while you are on our website, I suggest you do a very simple thing real quick right now, which you will be thankful later that you did. On that front page of our website is button in the middle says subscribe to our newsletter. When you click on that one, it pops up a simple form. Leave us our email and you will receive variety of our newsletters, which we send periodically with tips, announcement of new IRS laws, reminders of deadlines, lists of local networking events for real estate investors, and a lot of other very helpful information. So please take a couple minutes to subscribe to our newsletter so you stay up to date on this crucial information about taxes. So we just finished talking about wholesaling a few minutes ago, and I want to look at the other side of the real estate business. That other side is holding properties. Okay, holding properties as rentals. And a lot of new investors make a mistake which could be very costly and can result in an IRS audit. That mistake would be trying to put information about being a landlord on the wrong IRS forms. So what I'm talking about is right here. The form that we have right now on the screen was the form that we used for our real estate business as a wholesaler. If you look above, I'll bring up the top of the form. It's called Schedule C. It says so at the top right now in the left-hand top corner, Schedule C, which is called Profit or Loss from Business. And it sounds like the right form for business, but not for all business. It is the right form for wholesaling, not the right form for rentals. For rentals, we would need to use completely different form, and it's very important to remember which form is used for which business. Schedule C for wholesaling, Schedule E for rentals. Right now on the screen, I'm showing how that form looks. So at the top, it says Schedule E. So that for Schedule E at the form, and it's called Supplemental Income and Loss. So it's also business form, but it's for rental properties. So do not put your flips or wholesale information here. Put here only rental. So if it was a rental, what we're looking here is how rental schedule would look like. It has three columns each corresponding to one property. I have the same numbers in two columns here. Again, this is just for illustration purposes. It represents two different rental houses. They have, on my example, two identical numbers, which is absolutely impossible in real life. I realize that. This just shows how the form should look. And if you had third property, your third column would be completed with numbers. And if you had more than three, you would need an extra page of that Schedule E. If you look at that, it's kind of similar to the form we looked at, except it again has room to enter income, which in case of rentals would be rental income, and then various boxes to enter specific expenses such as advertising, repairs, insurance, taxes, utilities, all of that good stuff. That form has couple interesting points, and some mistakes are frequently done on that form, so I'll spend maybe 5 minutes looking at that form and trying to identify mistakes that are often done when you work with this form. First, mortgage. Line 12 is for mortgage, but if we read it and read that carefully, it says mortgage interest. A lot of people try to put here mortgage payment. That is a mistake. That form specifically asks for mortgage interest only. Your monthly payment includes interest, principal, and may include escrow, taxes, and insurance, but only mortgage interest goes on this form. That interest will be reported to you by your bank, your lender, on Form 1098, which comes somewhere in the next few weeks to you. If you are lucky, you already have it, but for many people it's still not produced. So whenever it comes, it will tell you what part of mortgage payment was interest. So put here interest only, nothing else. Another frequent mistake here is on line 16, which is taxes. These are property taxes, but it does not ask property taxes for the year 2015. What it asks for is property taxes that you paid during the year 2015. This is what it means. Taxes for the year 15 are actually due on January 31st of this year, of 2016. So right now is end of January 2016 when we are recording this webinar. You still have a couple days to pay your taxes if you have not done so yet. So if you are about to pay them now, they will be taxes for 2015, but they're being paid in January 16, which means they do not go here. They will go right here on the next year return because they are paid in 16. What we should count here is taxes that are paid last year, which could be maybe in December you paid the 15 taxes, maybe in January you paid 14 taxes, maybe both. So that number, when it's done correctly, should record property taxes that you paid at some time during the year 2015. Then the next line, the most interesting and unusual one, if you have never prepared taxes for rental properties, that would be line 18, depreciation. Depreciation is a very interesting concept in taxation. You are allowed, if you look at least, that's a deduction. So it's included with the rest of the deductions, such as advertising, cleaning, maintenance, commissions, insurance, all of that, and depreciation is of that group. So it's counted, which means it ends up deducted against your rent, and it means it reduces your overall taxes. So it's great. And if you look at your checkbook, you will never see a check that you remark for depreciation. So depreciation is kind of a paper deduction that is a phantom deduction in a way that you don't really make a payment for that, but you are allowed to take that on your tax return every time you report your rental properties. When people prepare their own tax returns, and we talk to a lot of clients who do their own taxes, unfortunately, very often that line I see blank. That means they never took any advantage of that deduction that every owner of a property can, and not only can, should take. What it represents is it's a funny calculation that allows you to deduct the cost of your property over many years. And in case of residential rentals, it would be 27.5 years. So if we are buying a 100,000 house and divide it over roughly 30 years, that's where we get that 3,000 number. So in a typical small investment grade house in Houston, you expect to see the depreciation being in that range, 3,000 or so. If the house is bigger, if we are talking about a high-end rental property, the depreciation deduction could be twice as high, 3 times as high. That is if you calculate the depreciation yourself and not using advanced techniques. Advanced techniques is not something that is a do-it-yourself project. But if you go to a specialist, somebody like our firm, and we work on depreciation together, there are some creative techniques, advanced methods, how you can take your depreciation and increase it dramatically, putting much more money into your pocket. I will show you an example that I go through when I teach classes. And right now I'm only going to show you a result, not going through the details of that example. But if we take a house, and right now we are looking at a 100,000 house that we buy in 14 and depreciate for 2 years. The simplest depreciation that everybody can do using their software will give you right now, if you look at the blue number, 5,000 and some change worth of depreciation over 2 years. And then we can go through a couple steps of improving that, and at the bottom it results for the same exact house. I want to stress what we are looking at. We are looking at the same exact house. However, we would take 15,000 of depreciation as opposed to the 5,000 that was done using simple method. 5 or 15. We essentially tripled depreciation by using advanced techniques. And the name of that you can see on your screen right now. It's called asset segregation. Another term for that is asset segregation or cost segregation. So asset segregation or cost segregation. That's a fancy name for an advanced method to increase depreciation on rental property and possibly put a lot of extra money in your pocket, saving it from Uncle Sam. As I mentioned before, this is a complicated thing, and I do not recommend attempting it on your own. Get help from a professional like us, and we will be happy to assist you in doing that. So those were deductions that we talk about when we discuss being a landlord and how landlording business is presented on a tax return. I'm going back right now and showing that form to see the bottom line. This is what happens. If we do math here and we look at what transpired in this situation with those houses, we can see that the houses have some cash flow. We're receiving 1,000 a month rent. That gives us 12,000 annual rent. We deduct some expenses. If we add them up and count, we will see that we have a 2,000 roughly cash flow a year from each of those properties. However, that was before depreciation. If you look at depreciation, depreciation adds 3,000 per property in additional deduction. And when we take into consideration, this is the interesting result. What you look at the bottom right now, and I shaded those two numbers, it has a negative 1,000. So what the tax return shows that the property is losing money. I want to bring your attention again, it is an unusual situation. We are talking about a property that does cash flow in real life. You do get money in your pocket from that property every month, assuming, of course, it's rented and not vacant. So in all rented months, it's working for you. However, when we present this situation to Uncle Sam, thanks to the depreciation deduction, it shows losing money, which means our overall taxes go down. Once again, we are making money, our bank account grows, our taxes go down. That's the best of both worlds. That's an excellent tax position to be in, and this is not at all unusual for owners of rental properties with mortgages on them, having positive cash flow, yet showing tax losses for Uncle Sam. That's what we refer to when we talk about tax benefits of owning real estate. This is illustration of how it works. Of course, everything can have a flip side. This can create difficult consequences, some additional taxation when you get rid of property, when you sell it eventually. And on my website, you can, again, go on our website, michaelplaks.com. One of the buttons says read the blog. There are some articles there, and we are updating that part of the website in the next few days. But there are some articles that I've written years ago that explain what happens when you sell a property, how much taxes will be due, and also it tells you how you can reduce those taxes using techniques to deal with capital gain taxes, defer them, sometimes eliminate that, do things known as 1031 exchanges, which is a very powerful technique to postpone paying your capital gain taxes when you sell a property that appreciated in value. All of that is very important knowledge in taxation when you are a real estate investor and helps you keep the most of your money and use it for investments rather than for your taxes. So that covers the rental part of the business, and we have the only other type of business that we need to talk about, and that type of business will be rehabs, flips, property that you buy and sell. I will use the same example. You may recognize that page that we looked at before. That's the page that I referred to while discussing wholesaling business. Right now, we will use that example to show what happens with flips. In this example, we are talking about a 90,000 income from flipping, and that's how we figure it out. We are talking about, right now that example is on screen for you, we are having 3 houses which are bought for 100 grand each. Then we put 10,000 in labor and materials. To simplify my example, I disregard all other costs such as closing costs, holding costs, financing. Of course, they are significant costs, but just to simplify my example, I ignore them. So we have 120 into the house. We sell it for 150, and that creates a profit of 30,000 per house. 3 houses like that a year, and here we come with our 90,000 income. If it was wholesale fee, we would report it right here at the top, 90,000, and go from there. Very important to know for flippers is, although that will produce correct result, it will also produce an IRS audit if we report it like that. We cannot report 90,000 at the top of the form when we are doing flipping. Why? Because the IRS knows from the title company every time you sold a house, the IRS gets a form 1099-S. That form tells the IRS that it was you with your name, social security number, and your address. It tells you how much you sold the property for and when it happened. So what the IRS will know is, the IRS will know that we sold 3 houses for 150 each. But the IRS will not know how much we put into those houses, how much we bought them for and put into repairs. The way we must report it to the IRS will be a couple extra steps. We have to start right now, I'm showing on screen on line 1 on that form. We must report 450. That would be combined sales price of the 3 houses. Then we must report how much we spent on buying and fixing that houses. And then we subtract that and get the correct number, 90. But we cannot skip the first 2 numbers. If you skip those numbers, expect a nasty letter from the IRS suggesting that you are hiding a lot of income from them. To avoid that letter, make sure to complete that form correctly or use a professional specialist who will help you do it right and avoid unnecessary grief dealing with the IRS. So we talked about 3 types of businesses. I want to spend a few minutes that we have remaining on the webinar to address a couple questions. And those are typical questions that come up, so I will be happy to talk about them. One was, somebody noticed that when we look at this form, what we are seeing is under profit and loss from business, it says sole proprietorship. Yes, it says so, that is correct. And the question is, what about the LLC? Because my business is an LLC. Excellent question. Let me answer that one. LLC is an entity that you create in the state of Texas in order to provide mostly legal protection for your investment. That's a good move, recommended, and it's something that most investors are doing. But that LLC needs to be later presented to Uncle Sam for taxation. What you need to know is an interesting quirk in the law that says, for the IRS, LLC that is owned by one person is called a disregarded entity. Disregarded entity really means the way it sounds. It's disregarded by the IRS. In other words, Uncle Sam does not care that you have the LLC. So if you are one person, a single investor, and you have no partners in that LLC, you will put it in on exact same form on this one, even though it says sole proprietorship. So really, it's sole proprietorship or single member LLC with one person owning that. I said single, and I said single referring to the single member term. However, that single member term does not necessarily mean single status. You can be married. In the state of Texas, a married couple, husband and wife, are considered one person. So if you have an LLC and that LLC is owned by husband and wife, again you will use the same exact form, Schedule C, or if it's rentals, Schedule E. So those forms that we looked at are used by people who do not have LLCs, single investors who own an LLC, or husband and wife, married couples who own an LLC. If you have an LLC with somebody except your spouse, like with your son, for example, with your brother, or with your friend, now that would be different. That we won't have enough time to cover in today's webinar, but I encourage you to contact our office and we will be happy to arrange a consultation and we can discuss what happens when you own an LLC with a person other than your spouse. Then it will need to file a different IRS form. It will be either a partnership tax return or maybe a corporate tax return, but there is no rule of thumb of how it's done. Well, there are some rule of thumbs, let me correct myself, but it's best to discuss those situations on case-by-case basis in a form of consultation, which is one of the services that we provide. Speaking of which, if we go to our website, let me give a brief overview is what we can do to help you be successful in real estate and what we can do to help you save money. So this is my website again, michaelplaks.com. And on that website, there are 6 buttons that give you 6 most important places. If you click on the first button, that first button says, let us prepare your tax return. That's what we do for 20 years, exclusively for real estate investors. There are very few people, even nationwide, that have that specialize in real estate the way we do. So we know more about tax laws and tax deductions and loopholes and aggressive strategies than any general type of CPA that you can find to prepare tax returns. So if you care about your bottom line, I recommend you give us a shot and let us show you how our specialized knowledge saves you money. So clicking on that button takes you to a page where we describe our pricing structure and our process, and you can take it from there. Next button, as I said, offers you free subscription to our newsletter. I highly recommend that you all do that right now. While you remember, just click on that button and complete that very simple form. That third button says read the blog and watch videos. We have some recordings available for everyone to see something from my earlier presentations, and extensive blog, which right now is not finished reorganization part on the website, but in a couple of days it will be more conveniently structured by topic and will be easy to review. The next one talks about classes. I do teach fair number of classes and do some free presentations. If you click on that button, here is what you will see. Here is what I will see. What you will see clicking on that button is some upcoming classes. There are 2 free presentations that are listed here. One will be next Tuesday, and then on Monday 15th. Next Tuesday, I'm speaking at the Fort Bend Real Estate Investor Meetup, and then on February 15th, talking about what to do when your records are not great. If your records are poor or missing, but you still need to prepare tax return. That will be a very informational presentation for the Realty Investment Club of Houston, but it's open to people who are not members as well. So everybody is welcome. On Saturday, February 20, there is a very interesting class that I want to mention, is where I will teach that class together with my good friend, real estate attorney Steven Newsom, and we're going to teach legal and tax issues and private lending. So if you are a private lender or using private money as a borrower, that is a great class that talks about legal and tax consequences and can save you from a lot of very costly mistakes. That class is priced at $497. However, right now we just started promoting it. It's at early bird discount price. You can save $200 and just go here online and register for the class. It costs $297. So those are the classes, and in the upcoming couple weeks, I am going to be at a lot of the networking meetings in the Houston real estate community, where I try to attend as many networking meetings as I can, organized by various great organizations such as Prosperity Group, one of my absolute favorites, of course. So it's easy to meet me there and talk about any kind of questions you have, and just have a chat about real estate business. One other question before I finish that came up from another attendee was about self-directed IRAs, about having rental properties in a self-directed IRAs. Question was, do I need to file a tax return for this? The answer is most likely no. I'm not avoiding answering. When I'm saying is most likely, this is why. Self-directed IRA is completely separate from you. So whatever happens in a self-directed IRA does not go on your tax return, and the best part about it, does not normally cause you to pay any taxes. It's a tax-free investment. It's not part of your tax return. So that part you do not need to do. However, under some circumstances, the self-directed IRA itself may incur some taxes and have to file some forms, and the tax is called UBIT tax, unrelated business income tax, and that tax is a complicated issue that we would need to discuss separately. That would happen with rental properties if you borrowed money to buy those properties inside your self-directed IRA. In other words, if your self-directed IRA had $50,000 and you bought $100,000, well, like your question mentioned two properties, so you bought 200,000 houses. That will be two houses, 100,000 each. That's 200,000 investment, but your IRA had only 50. You borrowed another 150 from somebody else. Then your IRA may have an issue with UBIT tax, and you can discuss that either with us or with custodian of your self-directed IRA. And right now, going back on my website, two more buttons that I want to show was, okay, we looked at classes. Next button talks about recorded seminars. There are two of our popular products that are available for sale. One is my recording of real estate bookkeeping seminar, which we had it on holiday sale, and holidays are over. I was planning to remove that button and put back the regular price. However, I decided to keep it since I was doing a webinar today. In case you guys are interested, you can still grab it while we have those discounted price, as I'm going to put it back into regular price since the holiday sale is over. But as of right now, it's on sale. Recording about real estate bookkeeping, and another great recording is course by my friend attorney Steven Newsom, Do-It-Yourself LLC Formation. It was a seminar taught by Steven where he went through specifics of real estate legal protection through LLCs, how it's done and how it should be done correctly. That thing is also on sale for now. And finally, the last button, but not the least, on our website is Real Estate Investment Pro, RIA Pro Guard program. This is a professional guidance program. You may call it coaching, although it's not quite that. That's something that we do together with Steve Newsom, and we help a lot of, not a lot actually, that's a limited program. We take only a handful of dedicated investors, so it's not a big program, very small one as a matter of fact, where we personally guide investors through building successful business plan, implementing that, avoiding legal mistakes, doing it professionally. That program is described in full detail on my website. And of course, yes, we also have that holiday sale discount, which is $2,000. You can save today, still using discounted registration before we take down the holiday sale. I was about to say it's over, but I just got another excellent question that came online, and the question was about, do I require a client to have all receipts and mileage logs, or is it our responsibility to give you the right numbers and have those just in case the IRS decides to audit? The latter. Meaning is when you bring information to me, to our firm for tax preparation, I don't need to see your receipts. I do not need to see how you kept your records. I will trust you. But if the IRS decides to audit you, you obviously will need to prove them because they are not as trusty as we are. Of course, your numbers will need to make sense, and we have some great tools, which I'm going to show you in a second, of example of what we are asking from our clients, what kind of information we would ask. We have a set of tools which we call Tax Organizer. They're developed by me over a number of years and cover comprehensive situations specifically in real estate, and here would be an example. I'm scrolling through that organizer right now on my screen. Right here, for each rental property, we would ask you to tell us rent and other income collected per month, and then annual totals for various types of maintenance and operating expenses. And then there is a page where you could list various work done on the property or some creative financing. That's a great tool that even if you do not use our services, if you prepare your own tax return, for example, that tool will help you greatly to organize your data and not miss deductions. Going back to the question is how not to miss deduction, well, our tool will help because right here, for example, it mentions different categories, which is a clue on how to do it. That tool is available from us. Give us a call or send us an email. We'll be happy to introduce, to share this tool with you. It's not a freebie, but it's very much worth its modest price. That said, I would like to wrap up our excellent webinar by first encouraging everybody to maximize your membership in Prosperity Group of Houston. I work with thousands of investors as my clients, and historically over the years, one thing that I see consistently is that it takes very dedicated person to be successful in real estate. And I did a presentation for Prosperity Group just a couple of weeks ago where I went through 5 keys of being successful in real estate. And those keys included having business plan, accountability, and great team, and 2 other things were other people's money and focus. Those 5 keys that make or break a real estate investor are available all in one place in great clubs in Houston, such as Prosperity Group. So if you are a member, and everybody who listens to this webinar is a member of Prosperity Group, I want you to use it to the maximum. Use these resources you have. Use the great experience and help of AC and team and their crew, their friends, and everybody else who come to meetings who are fellow investors. Build them into your team. Use their brain, use their resources to be successful. And if you ever need help with taxation and any issues related to IRS issues, to legal issues related to taxation, even though we are not providing legal services, but we can connect you with Steve Newsom, real estate attorney. We have that real estate pro guard program for the most focused investors to put you on the next level. We teach, we prepare tax return. We will be happy to help you any way we can, be on your team and help you be the best you can. And I wish everybody in 2016 tremendous success in real estate, making lots of money, lots of friends, and much success to you in this coming year. Thank you to Team, AC, Adam, and the rest of Prosperity Group for having me as a guest. And good night, everybody.
All right. Thank you very, very much, Mr. Michael Plaks. Thank you all for attending. We will see you the next webinar. Be sure to check out his website and get your tax information directly from the professionals. Thank you, guys. We will see you again soon. Good night.